Recession is coming, and if you keep a normal index portfolio, your net worth could drop 30 to 40% on paper in a matter of months. Most people panic, sell at the bottom, and then miss the recovery. But if you position correctly before the recession and have a plan for what to do during the crash, that same recession becomes the moment you quietly get rich while everyone else is terrified. In Brian, I have worked in fintech and banking for decades, and I've got a finance degree and an MBA as well. I have sat in risk meetings where portfolios worth billions were being repositioned because recession risk was rising. And in this video, I'm going to walk you through exactly how to invest when recession hits, what to hold, what to sell, how much cash to keep, and when to actually buy during a crash. Let's start with a hard truth. If you are in a classic 70% stocks, 30% bonds portfolio right now, you are more exposed than you think. That type of allocation can work in a normal environment, but if the S&P 500 falls 30 to 40%, a 70-30 portfolio can easily drop over 20% in value, sometimes more if the bond side is also under pressure like it was in 2022. In 2022, both stocks and bonds fell together, which is exactly what most people thought should never happen in a diversified portfolio. When your safe bonds drop alongside your stocks, you find out the hard way that diversification was not as strong as the backtest suggested. So the first move is simple. De-risk before the crash shows up in the headlines. Instead of 70% stocks and 30% bonds, shift to something closer to 50-50 or even 40% stocks and 60% defensive assets. But there is an even smarter way to do this. Build a more diversified defensive mix where not everything depends on the stock market and long-duration bonds. One example framework that works much better in recessionary periods is this: 40% stocks, 25% high-quality bonds, 15% commodities, and 15% real assets like REITs or infrastructure. That kind of allocation tends to have lower downside in deep drawdowns, because commodities and real assets often behave differently when inflation, rates, and growth all start shifting rapidly. Now, will that type of portfolio make you as much money as a full stock portfolio in a raging bull market? No. You might be looking at an expected long-term return more like around 6 to 7% per year instead of 9 to 10% if you were fully in stocks. But that trade-off is the entire point. In a deep crash, that more balanced mix might fall something like 10 to 15% when a traditional 60-40 is down closer to 30%. Smaller drawdowns matter more than most people realize. If your portfolio is down 30%, you need about 43% just to get back to break even. If you only fell 15%, you only need about 17.6% to recover. The less you fall, the easier and faster you compound when the recovery starts. Now let's talk about the part that actually builds wealth. What to do during the crash itself. Imagine the S&P 500 starts falling and headlines scream, "Recession is here." First it's down 10%, then 15%, then 20%. At that minus 20% mark, here's what you do with your core long-term positions. Nothing. A 20% drawdown is painful, but it's not necessarily a once-in-a-decade buying moment. Historically, markets have had plenty of 15 to 20% corrections that were not full-blown generational crashes. So if the index is down 20%, you stay calm, you keep your defensive allocation, and you continue your normal monthly investing. But once the index gets to around minus 30% from the previous peak, this is where your strategy changes. At that point, you stop thinking, "Is this the bottom?" and start following a pre-planned deployment schedule. This is where having dry powder pays off. You do not YOLO all of your cash at once. Instead, you use tranches. For example, say you have set aside an opportunity fund in cash equal to 10 to 15% of your portfolio. At around minus 30%, you might start with a modest deployment, maybe a first small tranche, while still preserving most of your cash for deeper levels. When the drop reaches around minus 40%, that's when you get more aggressive. You could deploy roughly 25% of your total reserved crash cash around that level. The reason is simple. Historically, a 40% drop in a broad index has usually happened in deep recessions or major crises. and forward 5 to 10-year returns from those levels have been extremely attractive. Then if the market continues to fall and hits around minus 50% from the peak, that's where you treat it as a generational buying opportunity. At that point, you might deploy 50% or more of your remaining reserves. You're not trying to nail the exact bottom tick. You're ensuring that if the market spends any meaningful time 40 to 50% below its highs, you're steadily accumulating ownership of high-quality assets at huge discounts. Here's why this approach works. Markets tend to recover a large chunk of their losses relatively quickly after the bottom. Historically, in the 12 months following a major bear market low, markets often recoup 40 to 50% of the drawdown. That means if you start buying aggressively when the index is down 40 to 50%, you are positioning yourself for a very strong rebound in your net worth when sentiment flips and liquidity returns. You're not betting on this week is the bottom. You're betting on over the next few years, human progress continues and risk assets go back up. But there's another lever that can dramatically change your results in a recession: sector rotation. Most people just hold the market and hope. You're going to be more intentional. In late cycle and early recession phases, certain sectors tend to get hit much harder than others. The first group you want to de-emphasize or even sell into strength before the recession fully bites is high beta, speculative growth, and unprofitable tech. These names can feel great in a bull market, but in a recession, their earnings are far out in the future, and investors suddenly demand cash flows today, not just promises tomorrow. That repricing can be brutal. What tends to hold up better when the economy slows? Defensive, cash-generating businesses. Think utilities, consumer staples, and quality dividend payers. People still need electricity, groceries, and basic household products whether the economy is booming or shrinking. So you tilt your equity exposure toward these kinds of businesses. You also prioritize companies with strong balance sheets, consistent cash flows, and a history of paying and growing dividends. A 3 to 5% dividend yield from a stable business, especially when bond yields are falling as the recession deepens, becomes a real cushion for your portfolio. Healthcare is another sector that historically shows resilience in downturns. People cannot postpone healthcare indefinitely. Demand is less sensitive to economic cycles. So as you rebalance, you shift some of your stock allocation into diversified healthcare exposure, whether through ETFs or a basket of strong large-cap healthcare names. Meanwhile, you avoid cyclical sectors like industrials and materials in the early part of the recession. Those sectors are more tied to construction, manufacturing, and global trade, which can slow sharply. Cyclicals can be fantastic buys later when the recovery is clearly underway, but they are often landmines if you load up too early. Real estate deserves its own line in your recession playbook. In a tightening cycle and early recession, real estate can get crushed by higher interest rates, financing stress, and falling transaction volumes. You do not need to jump into property or real estate-heavy investments at the first sign of weakness. Instead, you wait for something called capitulation, those moments where forced sellers, distressed listings, and steep discounts become visible. That's when you quietly start accumulating prime assets or high-quality REITs at valuations that may not appear again for years. Next, let's talk about bonds and fixed income, because this is where a lot of people either stay too short or accidentally take the wrong risk. In a recession, central banks typically shift from raising rates to cutting them. When rates fall, longer duration, high-quality bonds can experience significant capital gains, not just yield. So if you expect recession rather than runaway inflation, you gradually extend the duration of your bond holdings. Shift some of your capital from short-term instruments into intermediate or even long-term government bonds. If 10-year Treasury yields slide from, say, the mid-single digits down toward 2% during a deep slowdown, owners of those longer bonds can see powerful price appreciation on top of the coupon. However, recession is exactly when you do not want to be reaching for yield in junk bonds. High-yield corporate debt pays more interest precisely because default risk is higher. During a downturn, that default risk becomes real, so you stick to high-quality credit, A-rated and above corporates, and government bonds. Your fixed income sleeve is for stability and optionality, not for gambling on companies that might not survive. Dividend stocks deserve another mention here, because they often function as a bridge between equities and bonds in a crash. Many consumer staples and big brand companies target dividend yields in the 3 to 5% range and have long histories of paying through multiple cycles. While their stock prices can still fall in a recession, the dividend income keeps coming, and that cash flow can be reinvested into even cheaper shares as prices drop. Over a full cycle, reinvested dividends are a major driver of total return. That's why investors often use examples like Walmart or McDonald's as classic recession-resilient stocks. People keep buying affordable food and basic household items even when their budgets are tight, and those companies tend to keep throwing off cash. Now, none of this works if you don't have cash when the opportunity arrives. This is where most people fail. They are fully invested and then watch helplessly as great assets go on sale while they have no liquidity. So before the recession hits, you build two cash buffers. The first is your personal emergency fund, 3 to 6 months of essential expenses held in very safe liquid accounts. That protects your lifestyle if you lose your job or face an unexpected expense at the worst possible time. The second is your opportunity fund, which is separate from your emergency savings. This is 10 to 15% of your investable portfolio parked in cash or very short-term instruments. Right now in many markets, money market funds and short-term treasury bills have been yielding in the 4 to 5% or higher range in tightening environments. That means your dry powder is not just sitting idle. It is earning a decent low-risk return while it waits. Then when markets fall deeply, you are not panicking to raise cash by selling at a loss. You are calmly deploying an already prepared opportunity fund at better and better prices. Your biggest fear in a recession should not be, what if the market falls more? It should be, what if incredible opportunities appear and I have no cash to take advantage of them? The last piece of this framework is how you actually put money to work mechanically. Humans are terrible at timing, especially when scared, so you do not try to guess the bottom. Instead, you automate dollar cost averaging during the downturn. For example, if you can set aside an extra $500 a month during the recession, you commit to investing that amount regardless of headlines. Some months you'll buy at minus 25%, some at minus 35%, maybe some at minus 45%. Over time, you build a blended entry price that is dramatically lower than the previous highs without needing to be perfect. Combine that monthly averaging with the level-based deployment of your dedicated opportunity fund. The recurring contribution handles the emotional side, keeps you investing through fear. The level-based tranches let you be more aggressive precisely when valuations are the most compelling. That combo is where long-term wealth often accelerates. So let's put it all together in one clear game plan you can actually follow. Step 1, de-risk now. If you're sitting at 70-30 or heavier in stocks, consider shifting towards something like 40% stocks, 25% high-quality bonds, 15% commodities, and 15% real assets. Step 2, tilt your stock exposure away from speculative growth and toward defensive, dividend-paying sectors like utilities, consumer staples, and healthcare, while avoiding early cycle cyclicals until the recovery is visible. Step 3, upgrade your bond sleeve to longer duration, high-quality securities that stand to benefit when rates are cut, and stay far away from junk bonds that can blow up when defaults rise. Step 4, build your cash strategy. Lock in a 3 to 6 month emergency fund, then carve out an additional 10 to 15% of your portfolio as a dedicated opportunity pool in money market funds or short-term treasuries. Step 5, pre-commit your crash playbook. At minus 20% in the index, stay calm and continue normal contributions. At around minus 30%, start nibbling with a first small allocation of your opportunity fund. Around minus 40%, deploy roughly a quarter of it. Around minus 50%, treat it as a generational buying chance and deploy heavily, always maintaining some flexibility in case the drawdown overshoots. When the next recession hits, most investors will repeat the same pattern. Ignore risk when markets are high, then panic sell after big losses and sit in cash during the recovery. You're going to do the opposite. You de-risk intelligently before the crash, you maintain liquidity, and you follow a rules-based deployment plan on the way down. When the recovery begins, and historically, markets have often retraced a huge fraction of their losses within about a year from the bottom, you will already be fully positioned. From there, a 200% plus gain over the next full cycle is not unrealistic if you bought quality assets at deep discounts, and then just let compounding work. Recession is not the time to ask, what do I do now? It is the time to execute a plan you already made. So write down your allocation target, your sector tilts, your cash levels, and your deployment triggers. That way, when the fear hits, you are not guessing. You are simply following your own playbook. If every country in the world is drowning in debt, then who exactly is all that money owed to? It's one of those questions that sounds simple, but the deeper you go, the stranger and darker the answer becomes. Because when you look at the global financial system and you follow the money, you realize something. The debt isn't owed to an outsider. It's owed within the system, to institutions, to other governments, and even to you. So let's unpack the mystery of how the entire world can be in debt at the exact same time. Let's start with a number that should honestly terrify everyone. Global debt has officially crossed $300 trillion. That's more than 256% of the world's GDP, meaning even if every country stops spending on everything, no salaries, no infrastructure, no healthcare, nothing, and put every single dollar of economic output toward repaying debt, it would still take more than 2.5 years. And that's assuming the world economy magically stops shrinking while doing that, which it wouldn't. But here's where things get interesting. Advanced economies like the US, Japan, the UK, Italy, France, these aren't poor nations. These are wealthy, stable, developed economies, and yet their government debt has exploded to levels not seen in 80 years. Japan's debt is over 260% of GDP. The US is over $34 trillion and rising at the fastest pace in its history. The UK, Canada, Italy, France, all hitting historic highs. And emerging markets aren't far behind. Two-thirds of developing nations are in what institutions call debt distress, which is the polite economic term for their governments don't have enough money to pay the interest, let alone the debt itself. Countries like Ghana, Sri Lanka, Zambia have already defaulted. Others like Pakistan, Egypt, Tunisia are dangerously close. And yet, the global debt clock keeps spinning upward. Every government needs more money every year than it collects. That's the setup. Now we need to answer the real question. If every country is borrowing, who is lending? When governments borrow money, they don't go to one giant world bank and check out a loan like a library book. Instead, they issue government bonds. These are IOUs, promises to repay money plus interest over time. But who buys these IOUs? The answer is far more complicated and surprising than most people realize, because the lenders aren't some small elite group. They're everywhere in the financial system. A huge portion of government debt is held by domestic investors, pension funds, insurance companies, banks, and local investment funds. When the government owes trillions, a big portion of that is owed to retirees, savers, and institutions inside the country. Pension funds rely on government bonds because they're considered safe. Insurance companies need stable assets. Banks buy bonds because they're liquid and guaranteed. Index funds, mutual funds, bond ETFs, they all hold government debt. Meaning, when the government borrows, it borrows from its own people. Then you have foreign governments and investors. China holds over $800 billion in U.S. treasuries. Japan holds over $1 trillion. European countries hold each other's debt. Asian governments hold each other's debt. Global corporations, sovereign wealth funds, foreign banks, they all buy government bonds for stability. But they're not villains. They're investors seeking safety. And then you have central banks, the most mysterious and misunderstood holders of government debt. Central banks have the unique power to create money from nothing. Not symbolically, literally. When governments issue debt and private investors don't buy enough, central banks step in and buy the debt themselves. Where does the central bank get the money? It creates it. This is quantitative easing. The government issues debt. The central bank buys the debt. New money enters the economy. The Federal Reserve created over $4 trillion this way. The ECB created over 5 trillion euros. The Bank of Japan created so much money that it now owns over half of all Japanese government bonds. Half the nation's debt is owed to an institution that can never run out of money, never go bankrupt, and never demand repayment in a traditional sense. But if central banks can buy unlimited debt, why don't they eliminate it? Why not reset everything? To understand why, we need to understand what debt actually represents. Some people assume that if the world owes money to itself, everything cancels out. But that's not how the system works. Government debt isn't just a number, it's a contract. And for every debtor, there is a creditor. Pension funds, banks, investors, savers, insurance companies. If you erase government debt, you erase the assets of the institutions that hold it. Canceling debt isn't a reset. It's wiping out people's life savings. It would destroy pensions, retirement accounts, bank deposits, insurance payouts, investment portfolios. A debt jubilee isn't a celebration. It's a catastrophe. Debt also represents an intergenerational transfer. Every time a government borrows to pay today's expenses, it transfers the burden onto younger generations, future taxpayers, and citizens who aren't even born yet. Young people owe old people. Workers owe retirees. Future economic growth owes to past spending. Debt is the mechanism that financially connects generations over time. The most important part of the paradox is that the entire system survives on confidence. Government debt is the foundation of the banking system, the pension system, the insurance system, and the global financial system. If investors stop believing governments can repay, the system collapses instantly. That's why countries don't default voluntarily. That's why central banks buy unlimited debt. That's why the system can stretch and stretch and stretch until the moment people lose faith. Because the system doesn't run on money, it runs on trust. When trust collapses, the financial system collapses with it. So if every country is in debt, who is the money owed to? The answer isn't some shadowy outside entity. It's not a villain. It's not a secret group. The money is owed to you, to your pension fund, your bank, your insurance company, your retirement plan, your central bank, other governments, global investors, institutions, savers, and future generations. The world owes money to itself. The system works until it doesn't, until the moment creditors, pension funds, banks, insurers, foreign governments no longer believe they will be repaid. When that moment comes, everything stops. So the real question isn't, who is the money owed to? The real question is, how long will the world continue believing the system still works? Because the second that belief breaks, the entire global financial system collapses. But to really understand why this system keeps expanding, why global debt rises year after year with no realistic path of repayment, we need to look at the incentives built into modern economies. Governments don't borrow because they're irresponsible. They borrow because the system forces them to. In almost every major economy, economic growth is the political lifeline of the country. Growth keeps unemployment low. Growth keeps living standards rising. Growth pays for healthcare, military budgets, social programs, infrastructure, education, and pensions. Without growth, governments get voted out, markets panic, and social stability cracks. But the brutal truth is this: real economic growth, actual productivity growth, has slowed dramatically across the world. Population growth is slowing. Productivity gains are stagnating. Automation increases efficiency, but it doesn't generate enough broad-based wage growth. So what do governments do when organic growth fails? They manufacture growth using debt. Debt becomes the engine that keeps the economy moving. When governments spend borrowed money, they inject fuel into the system. Businesses make more revenue. Workers get paid. Banks make loans. Investors earn returns. And that spending artificially boosts GDP. But it creates a trap. To keep the economy from shrinking, governments have to borrow more next year, and even more the year after that. Eventually, debt becomes the foundation of the economy itself. And once you build a system on a foundation of debt, you can't stop borrowing. Because if you stop, the entire structure collapses. This is why you hear economists say things like, deficits don't matter, or debt is sustainable as long as interest rates stay low. They're not being naive. They're acknowledging a hard truth. In the current global financial system, growth is impossible without expanding debt. Countries borrow not because they want to, but because the system collapses if they don't. And here's where the paradox becomes even stranger. When governments borrow money, they create an asset for someone else. Pension funds want bonds. Insurance companies want bonds. Bank portfolios require bonds. So the economy actually demands that governments stay in debt. If governments tried to pay off all their debt, financial institutions would lose their safest assets. The system literally depends on an endless supply of debt to remain stable. Think about how bizarre that is. We've built a global economy where debt isn't a problem. It's a requirement, which raises a deeper question. If governments must borrow and institutions must lend, then how does the system ever fail? Why do debt crises happen at all? The answer is hidden in a single word: confidence. Governments can carry massive debt loads indefinitely, as long as investors believe they can repay. Confidence is the currency of sovereign debt. When investors trust a government, they lend cheaply and easily. When trust breaks, interest rates skyrocket, borrowing becomes impossible, and default becomes inevitable. This is why wealthy countries rarely default outright. Investors believe the US, Japan, and Europe will always find a way to pay. But emerging markets, their credibility isn't as strong. The moment investors lose confidence, panic spreads, interest rates spike, capital flees, currencies collapse, governments can't roll over their debt. A crisis erupts overnight. This confidence dynamic explains why the US, with $34 trillion in debt, can borrow at low rates, while smaller nations collapse with far less. The United States issues debt in the global reserve currency. Investors treat it as the safest asset on earth. Japan's debt exceeds 250% of GDP, but Japanese investors keep buying because they have nowhere else to go. But for a developing country with weak institutions, debt becomes deadly. This brings us to the most confusing part of the entire system: the role of central banks in the sustaining confidence. The Federal Reserve, European Central Bank, and Bank of Japan act like the emergency buyers of last resort. When confidence collapses, they step in and buy massive amounts of government debt to stabilize the system. But their power creates another illusion. When central banks buy government bonds, they aren't just supporting the economy, they're hiding the true cost of government borrowing. Interest rates stay low not because the market demands it, but because the central bank is manipulating it. This means governments appear far more financially healthy than they truly are. In reality, central bank intervention creates a form of financial anesthesia. It numbs the pain of excessive borrowing. It hides the real risk. It allows countries to take on more and more debt without facing immediate consequences. But like any anesthesia, it wears off. When inflation rises, central banks must reverse course. They stop buying debt. They raise interest rates. Suddenly, governments face the true cost of their borrowing. And that's when the cracks appear. This is exactly what happened globally in 2023 to 2025. Inflation surged, rates spiked, and suddenly governments that were perfectly fine at 1% interest rates started collapsing at 6%. Debt wasn't the problem. The cost of debt was. This is what economists fear most: a world where governments must roll over trillions of dollars in debt every few years at increasingly high interest rates. The debt doesn't need to be repaid, but the interest does. And when interest consumes more and more of government budgets, something breaks. Countries must choose between cutting spending, raising taxes, or printing money. Cutting spending triggers political collapse. Raising taxes triggers voter revolt. So most governments choose the third option. They print money. But printing money to cover deficits weakens currencies, fuels inflation, and further erodes confidence, making the debt crisis worse. This is the cycle that ultimately destroys economies. Not the debt itself, but the loss of trust in a government's ability to manage it. So the real danger to the global financial system isn't the size of the debt. It's when investors, banks, pension funds, foreign governments, ordinary citizens, look at a government and say, "I don't believe you anymore." Because the moment belief dies, the system dies with it. That's the fragile truth about global debt, a truth most people never hear. The world is not held together by money or gold or resources. It's held together by trust. And when trust breaks in one major economy, it spreads like wildfire. Debt markets freeze. Banks panic. Governments scramble. Investors rush to safety. A global chain reaction begins. Because in a world where every country owes money to every institution and every institution depends on government debt, one collapse can trigger the collapse of many. That's why the debt question fascinates so many people. It's not just a financial puzzle. The global economy heading into 2026 looks like a slow-motion accident. Record debt, a fragile consumer, rising geopolitical conflict, and policymakers boxed into a corner with fewer and weaker tools than before. When all four of those stress points line up at the same time, you no longer have a normal business cycle. You have a system where a recession is less of a maybe and more of a delayed consequence that's already baked into the trajectory. Let's start right at the top. The debt problem isn't just big, it's changing shape. Global public and private debt is now well over 2.5 times the size of the world economy, and that would already be dangerous in a low-rate world. In a higher-rate regime, it's like stacking explosives on top of a bonfire. Every time governments roll over bonds or companies refinance their loans, they don't just extend debt, they lock in higher interest costs that permanently eat into future budgets, profits, and wages. That's the first structural reason a 2026 downturn looks inevitable. The bill from the last decade of borrowing is finally coming due at the worst possible time. Look at what that means practically. Governments must choose between three bad options: cut spending into a slowdown, raise taxes into a slowdown, or borrow even more at higher rates and hope markets don't punish them. Corporations face similar choices: cut investment, cut staff, or take on expensive debt. None of those paths are growth-friendly, and all of them point toward weaker hiring, lower confidence, and slower expansion. When too much of the global income statement is diverted to interest instead of productive activity, the system becomes brittle. You don't feel the break on day one, but you feel it when the next shock hits. China's slowdown makes this even more dangerous. For years, global growth could lean on China's massive construction and export machine to bail out weaker regions. Now China is wrestling with a property sector hangover, demographic decline, and a structural pivot away from debt-fueled building. That means the world's second largest economy is no longer the same emergency engine it used to be. So you have record global leverage, rising rates, and the previous growth locomotive losing steam, all entering 2026 at once. If the debt side is the loaded gun, the consumer is the finger tightening on the trigger. In the US and other advanced economies, the bottom half of the income distribution is clearly under pressure. Credit card balances are high, delinquency rates across consumer loans are climbing, and savings buffers from the pandemic era are largely gone. People are relying more on credit to maintain the same lifestyle, just as interest costs make that credit more expensive. That's not a sustainable path, it's a countdown. Student debt stress is a quiet amplifier here. After years of pauses and relief, repayments and collections have restarted for millions of borrowers, with many already falling behind again. That shows up in rising delinquencies, falling credit scores, and less room in household budgets for discretionary spending. When you combine higher rents, sticky prices for essentials, and resumed loan payments, you end up with consumers who are technically employed but financially squeezed. They might not show up immediately in unemployment statistics, but they absolutely show up in retail sales, travel, dining, and big-ticket purchases. This is where the narrative flips from resilient consumer to consumer exhaustion. At first, households cut back on luxuries. Then they downgrade brands, delay upgrades, and cancel non-essential services. As that happens, businesses feel the pinch in revenue, respond with cost-cutting, reduce hiring, and slow wage growth. That feedback loop between stressed consumers and cautious companies is how economies slide from softening into stalling, and from stalling into contraction. By 2026, the combination of higher debt service, weaker consumption, and tighter credit standards makes a prolonged slowdown not just likely, but hard to escape. Now overlay geopolitics on top of this already fragile economic base. Trade and geopolitical tensions aren't background noise anymore. They're core macro drivers. A renewed tariff regime, especially one that targets major trading partners like China, hits the economy in a double-barreled way. First, it raises prices as imported goods get taxed. Then, once businesses and households adjust to those higher prices, it depresses demand, investment, and hiring. You pay more upfront, then get less growth later. Under an aggressive tariff and trade war scenario, the odds of a recession go up sharply because you are deliberately adding friction to a system already straining under debt and weak demand. The US-China decoupling adds a structural drag that doesn't go away quickly. As supply chains are rewired around politics rather than pure efficiency, costs rise and productivity suffers. That means lower potential growth globally, exactly when the world needs more growth to manage its debt. Add the ongoing Russia-Ukraine conflict, which has reshaped European energy markets, and persistent instability in parts of the Middle East that can send oil prices spiking without warning. Every flare-up acts like a tax on the entire world. Higher fuel costs, higher transport costs, and more uncertainty for businesses deciding whether to invest or wait. Here's the key. None of these geopolitical risks happen in a vacuum. They interact with debt and consumer fragility. Higher energy prices hit the same households already stretched by rent, loans, and credit card bills. Trade disruptions hit companies already grappling with higher interest costs and weaker demand. The result is not one big shock you can quickly recover from, but a series of overlapping blows that wear the system down. By the time 2026 rolls around, we're not talking about a single event causing a downturn. We're talking about accumulated damage finally showing up in the data. That brings us to the policy trap, the part of the story almost nobody normal has time to follow, but everyone ends up living through. In past crises, central banks could slash interest rates aggressively and flood the system with liquidity. In 2008 and 2020, that was the playbook. Cut, print, stabilize. This time is different. Major central banks have already been through a full hiking cycle to fight inflation, and while they are cutting at the margins, they cannot simply drop rates back to zero without risking another inflation wave. They're stuck between protecting price stability and supporting growth, and both objectives are now pulling in opposite directions. At the same time fiscal policy is constrained, governments are entering this slowdown with higher debt levels and larger deficits than before. That means big, open-ended stimulus packages are harder to sell politically and more dangerous financially. Bond markets are watching. The more governments spend to offset weakness, the more investors demand higher yields to hold that debt, which further increases interest costs and strains budgets. It's a loop. Try to spend your way out, and you might trigger a bond or currency scare that makes things worse. So you end up in a world where monetary policy is hamstrung by inflation and credibility concerns, and fiscal policy is hemmed in by debt and market discipline. That's the policy trap. The tools that used to break recessions now have serious side effects. You can't cut rates to zero without risks. You can't run massive deficits forever. Yet doing nothing allows a recession to deepen. The result is likely a slower, more drawn-out downturn where policymakers manage the decline instead of sharply reversing it. Markets are not blind to this. You see it in the way major institutions talk about 2026. Many baseline forecasts still show modest positive global growth, but the language around those forecasts keeps highlighting words like downside risks, fragile, and skewed to the downside. At the same time, big banks publish scenarios where the stock market takes a large hit, on the order of a 30% drop from highs, if tariffs escalate, consumer demand weakens further, or policy mistakes combine with geopolitical shocks. When those kinds of scenarios are on the table, the probability distribution for 2026 is clearly tilted away from everything is fine. Now here's the subtle but crucial point. You don't need global GDP to be deeply negative for this to feel like a global recession in real life. If headline growth is hovering barely above zero, population is still rising, and inequality is high, then a small positive number at the global level can mask a very real contraction in living standards for large parts of the population. Emerging markets might be growing modestly while advanced economies stagnate. Some sectors might boom, AI, defense, certain commodities, while consumer-facing businesses, housing, and small firms struggle badly. For many people, that will feel like a recession, regardless of the official label. So is the global recession of 2026 already baked in? If you define baked in as the risks are so lopsided that avoiding pain would require a miracle sequence of perfect policy and perfect luck, then yes, the path we're on points overwhelmingly towards some form of global downturn. The exact shape, mild versus severe, short versus drawn out, synchronized versus uneven, remains uncertain. But the combination of historically high debt being refinanced at higher rates, a consumer that is stretched, indebted, and losing buffers, geopolitical conflict and trade fragmentation, raising costs and uncertainty, policymakers constrained by inflation, deficits, and market discipline, makes a clean, painless, soft landing in 2026 extremely unlikely. Now let's talk to you directly as a viewer, because this isn't just macro theory. In Brian, I have worked in fintech and banking for decades, and I've got a finance degree and an MBA as well. When you look at cycles over time, what matters is not predicting the exact quarter when the recession is declared, but recognizing when the risk-return trade-off of doing nothing has flipped against you. Right now, you have leading indicators flashing red across multiple dimensions. That's when serious investors and ordinary families quietly shift from offense to defense, tightening budgets, reducing bad debt, building emergency funds, diversifying income, and rethinking portfolio risk. That's also why this channel now exists as Finance Clarified. The whole mission is to take complex macro signals, like the ones pointing toward 2026, and translate them into plain English, actionable steps you can understand and use. No jargon for the sake of sounding smart, no blind optimism or doom for clicks, just clear explanations of what's happening, why it matters, and what you can actually do about it. For this video specifically, the style, voice, and visuals should all reflect that mission. The script should feel like a conversation, not a lecture. Tight, punchy, with recurring mini hooks that pull the viewer forward. Here's the part nobody's talking about. This is where it gets really dangerous. Now let's connect this to your wallet. The narration should match the confident but calm tone you hear in the reference video. Firm, analytical, sometimes chilling, but always grounded in data and logic rather than theatrics. The branding needs to align with that same clarity. The channel name, Finance Clarified, should be supported by a clean, modern logo and banner. Bold typography, high contrast, simple color palette, dark backgrounds with light text in a single accent color, and visual cues like charts, trend lines, or a stylized globe that immediately communicate macro finance, clearly explained. The channel description should be updated to something along the lines of, "In Brian, I have worked in fintech and banking for decades. I got a finance degree and an MBA as well. On Finance Clarified, complex economic trends and market risks are broken down into clear, practical insights so you can protect and grow your money without the jargon or hype." Thumbnails should be overhauled to match the clearly finance style you referenced. Close-up presenter or strong graphic focal point, bold short phrases in large text, 2026 crash setup, debt bomb, consumer breaking, dark backgrounds with sharp contrast and simple iconography like red arrows down, cracked globes, or warning symbols. For previous videos, redesign the thumbnails to this standard so the channel feed looks consistent and clickable at a glance. For this specific video, a strong thumbnail might show a dimly lit globe with cracks running through it, a large 2026 in aggressive typography, and a phrase like "already baked in." The style should be instantly readable on mobile, with the Finance Clarified visual identity, colors, fonts, and layout applied consistently. That way, when viewers see one of your videos recommended next to Economy Strategist or other macro channels, they immediately recognize your brand and know what you stand for. High signal, clear macro breakdowns. In short, the macro story heading into 2026 is not one of calm normalization. It's one of accumulated imbalances finally colliding with hard limits. Debt, consumers, geopolitics, and policy are all pushing in the same direction. The global recession of 2026 may not be announced yet, but structurally, it's already in motion. The only real choice left is whether you enter it confused and unprepared, or fully informed and strategically positioned. Central banks are still talking about a neat, clean 2% inflation world, but the economy you actually live in looks nothing like that anymore. Deglobalization, aging populations, climate shocks, and record debt are quietly rewriting the rules. And if you keep planning your money around 2%, you're building your future on a broken assumption. In Brian, I have worked in fintech and banking for decades. I got a finance degree and an MBA as well. And in this video, the whole point is simple: to show you why the 2% era is probably gone for good, and what that means for your cash, your investments, and your career. Let's start with a brutally honest question. What if 2% isn't a target anymore? It's just a marketing slogan. For years, that number felt automatic. You had a globalized world, cheap labor, deep supply chains, low interest rates, and more or less manageable government debt. Central banks looked like magicians because the backdrop was doing half the work for them. That backdrop is gone. The forces driving prices now are structural, not cyclical. Higher inflation isn't just a spike. It's becoming the new floor. The first structural force is deglobalization, and this one hits you straight through the checkout line. For decades, companies could chase the absolute cheapest place on earth to make your phone, your clothes, your electronics. That made everywhere model push prices down and made 2% inflation easier to hit. Now that engine is running in reverse. The US-China relationship has shifted from strategic partner to strategic rival, and that shows up as tariffs, trade restrictions, export controls, and investment bans. Every one of those frictions is a cost. Think about what's happening with tariffs in particular. When a government slaps higher tariffs on imports, companies don't just eat those costs out of kindness. They raise prices, change suppliers, or both. That means you either pay more for the same product, or you get a more expensive version made in a friendlier country. Add that to thousands of new trade restrictions in recent years, and you're looking at a world where moving goods is permanently more expensive and more complicated than it was in the 2000s and 2010s. At the same time, companies are moving from just-in-time to just-in-case supply chains. That sounds like corporate jargon, but it has very real consequences for you. Just-in-time means razor-thin inventories and maximum efficiency. Just-in-case means holding extra stock, using multiple suppliers, and sometimes producing closer to home. That makes the system more resilient, but also more costly. Reshoring, nearshoring, and friendshoring are nice buzzwords, but you don't get them for free. If you stop using the cheapest worker in the cheapest factory on the planet, your costs go up. Here's a simple way to translate all the deglobalization talk. Every time you hear resilient supply chains, think baked-in price pressure. You might not notice it immediately because companies smooth it out, play with margins, or hide it inside premium versions. But over years, this shift acts like a slow-moving tax on consumers. That's a key reason the world is drifting toward a higher inflation baseline rather than snapping neatly back to 2%. The second structural force is demographics, and this one is slow, predictable, and ruthless. Rich countries are getting older. That means fewer workers, more retirees, and a rising dependency ratio, more people drawing pensions and healthcare benefits, supported by a shrinking pool of active workers. For inflation, that's a toxic mix. When labor is scarce, workers have more bargaining power. Employers must raise wages to attract and retain talent, especially in essential service sectors like healthcare, logistics, and skilled trades. Higher wages are great if you're the one receiving them, but they also feed into higher prices. Most services are labor-heavy. Think childcare, elder care, hospitality, repairs, education, medical services. When wages rise in those sectors, businesses pass a chunk of that cost on to you. That's why services inflation tends to be sticky. Goods prices can fall when supply chains normalize or technology improves. But service prices rarely go backwards. In an aging society with structural labor shortages, that stickiness gets worse. Then there's the government side of aging. When more people retire and live longer, pension and healthcare bills explode. Governments have three options: cut benefits, unpopular; raise taxes, also unpopular; or borrow more and hope growth and inflation bail them out later. Guess which path is usually chosen? Higher age-related spending funded by more borrowing adds another layer of pressure on the system. You end up with bigger deficits and more debt in a world that is already drowning in IOUs. If you've ever wondered why it feels like you work harder to stand still financially, demographics are part of that story. Fewer workers, more retirees, and rising care costs mean the system quietly leans on you through taxes, through prices, and through the erosion of your future benefits. That's not a 2% world. That's a grind higher inflation world. Now let's talk about the monster everyone knows about, but nobody really plans for properly: debt. Global debt, governments, households, corporations combined, is now more than double global GDP. That was survivable when interest rates were near zero. It is a very different world with higher yields. Once central banks hiked rates to combat the post-pandemic inflation spike, the interest bill on that mountain of debt exploded. For many governments, debt servicing is now one of the biggest budget items. When interest costs eat a huge chunk of tax revenue, governments get trapped. Do they slash spending and risk recessions, protests, and political chaos? Do they raise taxes and anger voters and businesses? Or do they let inflation run a little hotter, quietly shrinking the real value of what they owe? History tells you exactly how this usually plays out. Inflation becomes a politically convenient, silent partner. Officially, the target stays at 2%. In practice, policymakers tolerate something higher for a bit longer, and that bit longer turns into the new normal. There's also a financial stability angle. If central banks kept rates extremely high for years to crush inflation down to exactly 2%, heavily indebted governments, banks, and corporations could crack. So they walk a tightrope, talk tough on inflation, but pull back before the system breaks. That safety instinct is rational, but it also means inflation never gets fully squeezed out. It settles in a higher range. You end up in a world where 3% becomes good enough, even if nobody wants to say that out loud. The fourth structural force is climate change, and this is where economics and the real world collide. Extreme weather is no longer a rare event. It's annual, sometimes monthly. Heat waves, floods, storms, and droughts damage crops, destroy infrastructure, and disrupt logistics. Every time major harvests are hit, food prices jump. Every time critical infrastructure gets knocked out, rebuilding costs surge and insurance premiums rise. Food and housing are big parts of your budget. When those prices rise repeatedly, they anchor higher inflation expectations. On top of that, you've got the cost of the energy transition. Moving from a fossil fuel heavy system to a cleaner, more resilient grid requires trillions in investment. Renewable capacity, storage, transmission lines, EV infrastructure, climate-proofing cities and ports. Over the long term, that can boost productivity and maybe lower certain costs. But in the near and medium term, it often raises prices. Carbon taxes, stricter regulations, and higher input costs for energy-intensive industries don't magically disappear. They trickle down. Put all of this together and you see the pattern. Deglobalization equals more expensive supply chains. Aging equals tighter labor markets and higher wage-driven services inflation. Debt equals pressure to tolerate higher inflation to avoid fiscal and financial crises. Climate equals repeated supply shocks plus massive transition spending. Any one of these would make 2% harder. All four at once make it borderline unrealistic as a stable, long-run baseline. That doesn't mean inflation explodes into double digits forever. It means instead of oscillating neatly around 2%, it might stabilize more around 3 to 4%, with frequent spikes when something breaks: war, tariffs, climate events, energy shocks. So what does this higher baseline actually mean for your money? Let's start with cash. Cash is still important for emergencies and short-term needs, but in a structurally higher inflation world, it's a terrible long-term asset. At 2% inflation, prices roughly double in about 35 years. At 3 to 4%, they can double in about 18 to 24 years. That's your rent, food, healthcare, and retirement lifestyle quietly slipping away while the number in your bank account looks the same. If you're hoarding cash because it feels safe, understand that you're choosing a guaranteed loss in purchasing power. Next, fixed income. Traditional bonds and fixed deposits become much trickier. If your bond yields 4% and inflation runs at 3.5%, your real return is barely positive. If inflation is underestimated, you might actually be losing purchasing power. The old mental model, bonds are safe, stocks are risky, was built in a world of falling inflation and falling interest rates. In a higher inflation, more volatile world, safe instruments can quietly destroy your real wealth if you don't pay attention to the inflation-adjusted return. That doesn't mean abandoning bonds. It means being more strategic. Shorter maturity bonds, inflation-linked bonds where available, and higher quality credit can still play a role. But you can't just lock into low yields and assume inflation will meekly slide back to 2% to save you. Your fixed income allocation has to be designed around the idea that inflation might average higher than what central banks still claim to be targeting. Now, real assets start to matter more. Historically, certain types of real estate have been decent inflation hedges, especially when rents can be adjusted and demand is stable or growing. Not all real estate is equal. Office space in a dying downtown is very different from residential in a growing, supply-constrained area, but the general idea holds. Owning productive, scarce, real assets helps protect you from a rising price level. Commodities and commodity-linked stocks also gain relevance in this environment. Energy, metals, agriculture, all are directly tied to inflation dynamics and to the big transitions in trade and climate policy. Another piece people underestimate is equity in high-quality, cash-generating businesses with pricing power. Companies that can raise prices without losing customers and maintain healthy margins can pass inflation onto the market instead of absorbing it. Owning slices of those companies through stocks or ETFs can be a powerful way to keep your portfolio anchored to the real economy rather than to nominal promises. In a world that's more inflation-prone, owning productive assets beats owning IOUs. Fighting higher inflation with savings accounts and low-yield bonds is like fighting a forest fire with a water pistol. You might slow things down a bit, but you're not winning that battle. You need tools, assets that can grow faster than the fire spreads. There's also your income side, and this is where most people fall asleep. In a structurally higher inflation world, your salary growth is just as important as your portfolio. If your wages grow slower than inflation, it doesn't matter how clever your asset allocation is. You are losing ground. That means you have to treat skill building, career moves, and negotiation as core parts of your inflation strategy. Choosing industries with structural tailwinds, roles with bargaining power, and employers that actually keep up with the cost of living becomes a form of financial self-defense. Think about wage negotiations differently. In a low-inflation world, missing a raise by 1% one year didn't kill you. In a 3 to 4% world, repeatedly accepting cost of living increases that lag reality compounds into a massive lifetime shortfall. If prices are rising faster, you need your skills, your output, and your bargaining skills to rise faster too. You can't control macro policy, but you can control your human capital. Your saving strategy also needs a complete recalibration. If you're using a retirement calculator that assumes 2% inflation, update it. Plug in 3 to 4% and see what happens to your number. Spoiler: the target jumps, sometimes dramatically. That might feel discouraging at first, but it's much better to confront reality now than find out at age 65 that your nest egg buys 30 to 40% less lifestyle than you expected. Instead of aiming for the smallest possible enough, you need to build in inflation resilience. And remember, this isn't about panicking. It's about adjusting. Higher baseline inflation doesn't mean you can't build wealth. It means you have to be more intentional. Less lazy cash beyond your emergency fund. Smarter, inflation-aware, fixed income choices. More exposure to real assets and businesses with pricing power. A deliberate plan to grow your income faster than prices, financial models and retirement plans that assume a higher, more volatile inflation path. The 2% inflation target belonged to a very specific world: hyperglobalization, abundant cheap labor, relatively low debt burdens, and a climate that hadn't yet turned into a full-blown economic risk factor. That world is gone. In its place is a more fragmented, older, hotter, more indebted global system where 2% isn't impossible for short stretches, but it's no longer a reliable anchor. Central banks can still influence inflation, but they can't fully override these structural forces. If you keep planning your financial life around yesterday's inflation regime, you're setting yourself up to be quietly, slowly robbed by the new one. The people who come out ahead in this era will be the ones who recognize that higher inflation isn't a temporary glitch. It's a new baseline to design around. Build a plan that assumes more inflation than you'd like, aim for real returns above that hurdle, and treat your skills and income as core inflation hedges, not an afterthought. On this channel, the whole mission is to help you see around corners like this, so you don't wake up 10 or 20 years from now wondering where your purchasing power went. If you're still planning your life assuming inflation magically returns to 2% and stays there, it's time to update your playbook, because the world that made that number easy is over, and your money needs to adapt.